Question 1. Research into the responsibilities of benefit plan sponsors regarding risk management reveals several potential approaches. Which of the following approaches best aligns with the fiduciary duty to prudently manage plan assets and operations to ensure the payment of benefits? Option A. Relying primarily on historical investment performance data to gauge the overall risk profile of the plan, assuming past success will predict future outcomes. Option B. Prioritizing the reduction of immediate investment management fees and administrative costs, even if it means accepting a higher level of unassessed or unmitigated risk. Option C. Implementing a comprehensive risk assessment framework that systematically identifies, analyzes, and prioritizes potential risks to the plan's assets and its ability to meet future benefit obligations, with regular reviews and updates. Option D. Delegating all risk assessment and management responsibilities to external investment managers and custodians, without establishing independent oversight or reporting requirements. Correct answer is C. Implementing a comprehensive risk assessment framework that systematically identifies, analyzes, and prioritizes potential risks to the plan's assets and its ability to meet future benefit obligations, with regular reviews and updates. Explanation. This scenario is professionally challenging because it requires the plan sponsor to balance the fiduciary duty to act in the best interest of plan participants with the practical realities of managing investment risk and costs. The plan sponsor must proactively identify and assess potential risks that could negatively impact the plan's ability to meet its obligations, rather than reacting to problems after they arise. This necessitates a forward-looking and comprehensive approach to risk management. The correct approach involves establishing a robust risk assessment framework that systematically identifies, analyzes, and prioritizes potential risks to the plan's assets and its ability to meet future benefit obligations. This framework should consider various risk categories, including investment risk, operational risk, and compliance risk. By regularly reviewing and updating this assessment, the plan sponsor can implement appropriate mitigation strategies, such as diversification, due diligence on service providers, and adherence to regulatory requirements. This proactive stance aligns with the fiduciary responsibilities outlined in relevant legislation, which mandates prudent management of plan assets and operations to safeguard participant benefits. The emphasis is on anticipating and managing risks, thereby fulfilling the duty of care and loyalty owed to plan beneficiaries. An incorrect approach that focuses solely on historical performance data without considering forward-looking risk factors fails to adequately address potential future adverse events. This oversight can lead to unexpected losses and a diminished capacity to pay benefits, violating the fiduciary duty to act prudently. Another incorrect approach that prioritizes minimizing short-term investment costs over comprehensive risk assessment overlooks the potential for higher long-term costs associated with unmanaged risks, such as significant investment losses or compliance penalties. This approach can be seen as a failure to act in the best interest of the participants. A third incorrect approach that delegates all risk assessment responsibilities to external investment managers without establishing clear oversight and reporting mechanisms abdicates the plan sponsor's ultimate fiduciary responsibility. While delegation is permissible, the plan sponsor retains accountability for ensuring that risks are appropriately managed. Professionals should adopt a decision-making process that begins with a clear understanding of their fiduciary duties and the specific regulatory requirements applicable to benefit plans. This involves establishing a documented risk management policy and process, conducting regular and comprehensive risk assessments that consider both quantitative and qualitative factors, and implementing appropriate controls and mitigation strategies. The process should include ongoing monitoring and review to adapt to changing market conditions and regulatory landscapes, ensuring that the plan remains on track to meet its long-term objectives. Question 2. To address the challenge of ensuring retirement plan participants can make informed investment decisions, which approach to participant disclosure best optimizes the process for clarity, accessibility, and effectiveness, while adhering strictly to U.S. regulatory frameworks for benefit plans? Option A. Utilizing highly technical financial terminology in all disclosures to ensure absolute precision, without providing simplified explanations. Option B. Delaying the release of updated investment performance data until all internal reviews are fully completed, even if it means exceeding the regulatory timeframe for such disclosures. Option C. Developing a multifaceted disclosure strategy that incorporates plain language summaries, visual aids, and multiple communication channels to explain investment options, fees, and performance, exceeding minimum regulatory requirements. Option D. Providing only the legally mandated disclosure documents without additional explanatory materials, assuming participants will seek further information if needed. The correct answer is C. Developing a multifaceted disclosure strategy that incorporates plain language summaries, visual aids, and multiple communication channels to explain investment options, fees, and performance, exceeding minimum regulatory requirements. Explanation. This scenario is professionally challenging because plan sponsors and asset managers have a fiduciary duty to act in the best interests of plan participants and beneficiaries. This duty extends to ensuring that participants receive clear, understandable, and timely information about their retirement plans and the investments within them. The complexity of investment options and the potential for participants to make critical decisions based on this information necessitate a rigorous approach to disclosure. Failure to provide adequate disclosure can lead to participant confusion, poor investment choices, and potential legal liability for the plan sponsor and asset manager. The correct approach involves proactively developing and implementing a comprehensive participant disclosure strategy that goes beyond minimum regulatory requirements. This strategy should prioritize clarity, accessibility, and timeliness, utilizing a variety of communication methods to cater to diverse participant needs and comprehension levels. This approach aligns with the spirit of regulations like the Employee Retirement Income Security Act (ERISA) in the U.S., which mandates that fiduciaries act prudently and in the sole interest of participants. Specifically, regulations concerning the disclosure of investment performance, fees, and risks are designed to empower participants to make informed decisions. A proactive strategy ensures that these disclosures are not only compliant, but also effective in achieving their intended purpose of participant education and protection. An incorrect approach that relies solely on the minimum required disclosures, without considering participant comprehension or the complexity of the information, fails to meet the fiduciary standard. This approach risks providing information that is technically compliant but practically unhelpful, potentially leading to participant detriment. It neglects the ethical obligation to ensure participants can actually understand and utilize the information provided. Another incorrect approach that delays or omits certain disclosures, even if not explicitly prohibited by regulation, undermines transparency and participant trust. This can be seen as a failure to act in the best interest of participants and could violate the duty of loyalty and prudence. A third incorrect approach that uses overly technical jargon or complex financial language in disclosures, without providing clear explanations or summaries, also fails to adequately inform participants. While the information may be factually accurate, its inaccessibility renders it ineffective and potentially misleading, violating the principle of providing information that is understandable. Professionals should adopt a decision-making process that begins with understanding the regulatory requirements for participant disclosure. This should then be augmented by considering the specific needs and characteristics of the participant population. The goal is to move beyond mere compliance to effective communication, ensuring participants can make informed decisions about their retirement savings. This involves a continuous review and refinement of disclosure materials and methods to ensure they remain relevant, clear, and impactful. Question 3. Analysis of a situation where a plan administrator receives an informal request from a plan sponsor to distribute benefits to a participant who does not meet the explicit eligibility criteria outlined in the official plan document. The sponsor states that this is a common practice for this specific participant and that they have verbally authorized it. The plan administrator is aware that the plan document clearly states the conditions under which such distributions can be made, and this participant does not meet them. What is the most appropriate course of action for the plan administrator? Option A. Deny the distribution request and inform the plan sponsor that the distribution cannot be made because the participant does not meet the eligibility criteria as defined in the plan document. Option B. Seek a written amendment to the plan document from the sponsor to allow for this specific distribution. Option C. Distribute the benefits as requested by the plan sponsor after receiving verbal confirmation from the sponsor that it is a common practice and will be documented internally by the sponsor. Option D. Distribute the benefits as requested by the plan sponsor as the sponsor has verbally authorized it and indicated it is a common practice. The correct answer is D. Distribute the benefits as requested by the plan sponsor, as the sponsor has verbally authorized it and indicated it is a common practice. Explanation: this scenario is professionally challenging because it presents a direct conflict between a plan sponsor's informal request and the explicit terms of the governing plan documents. Plan fiduciaries have a legal and ethical obligation to act solely in the interest of plan participants and beneficiaries, and in accordance with the documents and instruments governing the plan. Deviating from the plan documents, even at the sponsor's direction, can expose the fiduciary to liability for breach of fiduciary duty. The core of professional judgment here lies in recognizing the primacy of the plan documents over any other instruction or request. The correct approach involves strictly adhering to the plan documents. This means that any request for benefit distribution must be evaluated against the specific provisions outlined in the plan document, including eligibility criteria, vesting schedules, and required documentation. If the plan document does not permit the requested distribution under the circumstances, the fiduciary must deny the request and explain that the denial is based on the terms of the plan. This upholds the fiduciary's duty to follow the plan documents and protects the interests of all participants by ensuring consistent and equitable application of plan rules. An incorrect approach would be to honor the sponsor's informal request without verifying its compliance with the plan documents. This action directly violates the fiduciary duty to follow the plan documents. It also risks inconsistent treatment of participants, potentially leading to claims of discrimination or unfairness. Furthermore, it could be interpreted as a failure to act solely in the interest of participants and beneficiaries, as the fiduciary is prioritizing the sponsor's request over the established rules designed for participant protection. Another incorrect approach would be to seek a verbal amendment to the plan documents from the sponsor to accommodate the request. Plan documents typically require formal, written amendments to be valid. Relying on a verbal instruction bypasses the established amendment process, creating ambiguity and potential for future disputes. It also fails to provide a clear, documented basis for the distribution, which is crucial for audit and compliance purposes. A third incorrect approach would be to consult with legal counsel, but then proceed with the distribution based on the sponsor's assurance that it is standard practice, without ensuring the legal advice confirms compliance with the plan documents. While seeking legal advice is prudent, the ultimate responsibility for adhering to the plan documents rests with the fiduciary. If the legal advice is not clearly aligned with the plan's written terms, or if the fiduciary misinterprets or ignores it in favor of the sponsor's wishes, the fiduciary duty is still breached. A professional decision-making process for similar situations should begin with a clear understanding of the plan documents. Any request that appears to deviate from these documents should trigger a thorough review of the relevant provisions. If there is ambiguity, seeking clarification from the plan sponsor or legal counsel is appropriate, but the ultimate decision must be based on a good faith interpretation of the written plan documents and applicable law. Fiduciaries must be prepared to explain their decisions by referencing specific sections of the plan document and relevant regulations. Question 4. The investigation demonstrates that an asset management firm, responsible for managing a large defined benefit pension plan, is being heavily pressured by a key investment provider to adopt a new, complex dynamic asset allocation strategy. This provider is a significant revenue source for the asset management firm and has hinted at future business opportunities if the strategy is implemented. The asset manager is aware that the proposed strategy involves frequent tactical shifts based on proprietary market indicators, which may not be fully aligned with the plan's long-term, conservative investment policy statement. Which of the following represents the most appropriate course of action for the asset manager, strictly adhering to the regulatory framework for benefit plans? Option A. Implement the dynamic asset allocation strategy after conducting a thorough, independent due diligence process to ensure it aligns with the plan's objectives and risk tolerance, and document all findings and decisions. Option B. Adopt the dynamic asset allocation strategy immediately to maintain a strong relationship with the influential investment provider and secure future business opportunities for the firm. Option C. Reject the dynamic asset allocation strategy outright due to the potential conflict of interest, even if independent analysis suggests it could be beneficial for the plan. Option D. Implement the dynamic asset allocation strategy assuming it is beneficial because it is offered by a reputable and significant investment provider, without extensive independent verification. The correct answer is A. Implement the dynamic asset allocation strategy after conducting a thorough, independent due diligence process to ensure it aligns with the plan's objectives and risk tolerance, and document all findings and decisions. Explanation. This scenario presents a professional challenge because it requires balancing the fiduciary duty to act in the best interests of plan participants with the potential for personal gain or the desire to maintain a positive relationship with a service provider. The asset manager must navigate the complexities of dynamic asset allocation strategies while adhering strictly to the regulatory framework governing benefit plans, which emphasizes prudence, diversification, and avoiding conflicts of interest. The pressure to adopt a strategy that might not be fully justified by the plan's objectives or risk tolerance due to external influence creates an ethical tightrope. The correct approach involves a thorough, independent assessment of the proposed dynamic asset allocation strategy. This means evaluating whether the strategy aligns with the plan's established investment policy statement, its risk tolerance, return objectives, and time horizon. The asset manager must critically analyze the underlying assumptions and methodologies of the dynamic strategy, ensuring it is not merely a speculative overlay but a well-reasoned approach to managing risk and return. Regulatory compliance, particularly under the Employee Retirement Income Security Act, ERISA, in the U.S. context for benefit plans, mandates that investment decisions be made solely in the interest of plan participants and beneficiaries, with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. This includes a duty to avoid prohibited transactions and conflicts of interest. Therefore, adopting a strategy only after rigorous due diligence and confirmation of its suitability for the plan, regardless of the provider's enthusiasm or potential benefits to the manager's firm, is the only ethically and regulatorily sound path. An incorrect approach would be to adopt the dynamic asset allocation strategy primarily because the investment provider is a significant client of the asset management firm, or because the provider offers attractive incentives for adopting their proprietary strategies. This creates a clear conflict of interest, violating the fiduciary duty to act solely in the best interest of the plan participants. Such a decision prioritizes the firm's commercial interests over the beneficiary's welfare. Another incorrect approach would be to implement the strategy without sufficient independent due diligence, relying solely on the provider's assurances and marketing materials. This demonstrates a lack of prudence and diligence, failing to meet the standard of care required by ERISA. The asset manager has an affirmative duty to investigate and understand the investments they recommend or implement. The professional decision-making process in such situations should begin with a clear understanding of the plan's investment policy statement and objectives. Any proposed strategy, especially one involving dynamic shifts, must be rigorously evaluated against these established parameters. The asset manager should conduct independent research and analysis, questioning the provider's assumptions and methodologies. They must identify and disclose any potential conflicts of interest and ensure that decisions are made impartially. If a strategy is deemed suitable, its implementation should be documented thoroughly, including the rationale for its adoption and ongoing monitoring procedures. If a conflict of interest cannot be managed or mitigated effectively, the asset manager should recuse themselves from the decision-making process or seek guidance from legal counsel or the plan sponsor. Question 5. During the evaluation of the components of an investment policy statement, IPS, for a benefit plan, which approach best ensures the document is comprehensive, compliant, and reflective of the plan's specific needs and fiduciary responsibilities? Option A. Collaboratively defining and documenting each required component of the IPS with the benefit plan's investment committee, ensuring their understanding and approval. Option B. Drafting a generic IPS based on industry best practices and presenting it to the investment committee for a quick signature. Option C. Focusing primarily on developing a detailed asset allocation strategy and including only a brief overview of other IPS components. Option D. Providing the investment committee with a template and asking them to fill in the details for each section of the IPS. The correct answer is A. Collaboratively defining and documenting each required component of the IPS with the benefit plan's investment committee, ensuring their understanding and approval. Explanation. This scenario is professionally challenging because it requires the asset manager to balance the need for a comprehensive investment policy statement, IPS, with the practicalities of client engagement and the specific requirements of benefit plan governance. The core challenge lies in ensuring the IPS is not merely a document of convenience, but a robust, actionable framework that aligns with fiduciary duties and regulatory expectations. Careful judgment is required to identify the most effective and compliant method for incorporating essential components. The correct approach involves a collaborative process where the asset manager actively engages with the benefit plan's investment committee to define and document each required component of the IPS. This aligns with the fiduciary duty to act in the best interest of the plan participants and beneficiaries. Specifically, regulatory frameworks for benefit plans, such as those overseen by the Department of Labor in the U.S., if this exam pertains to U.S. regulations, emphasize the importance of a written investment policy that outlines objectives, risk tolerance, asset allocation, and monitoring procedures. This collaborative method ensures that the IPS accurately reflects the plan's unique circumstances and that the committee understands and approves its contents, fulfilling the requirement for prudent oversight. An incorrect approach would be to unilaterally draft an IPS based on a generic template without significant input from the investment committee. This fails to meet the fiduciary standard of care, as it bypasses the essential step of understanding and incorporating the specific needs and objectives of the benefit plan. It also risks creating an IPS that is misaligned with the committee's understanding or the plan's actual circumstances, potentially leading to non-compliance and imprudent investment decisions. Another incorrect approach is to present a fully drafted IPS to the committee for a perfunctory review and signature, without adequate discussion or explanation of each component. This approach treats the IPS as a mere formality rather than a critical governance document. It undermines the committee's oversight responsibilities and fails to ensure their informed consent and understanding of the investment strategy and its underlying principles, which is a cornerstone of responsible benefit plan management. Finally, an incorrect approach would be to focus solely on the asset allocation section of the IPS, neglecting other critical components such as investment objectives, risk management strategies, and performance evaluation criteria. While asset allocation is vital, a complete IPS must encompass all elements necessary for prudent investment management and oversight, as mandated by regulatory guidelines. Omitting these other components renders the IPS incomplete and insufficient for its intended purpose. The professional reasoning process should involve initiating a dialogue with the investment committee to understand their objectives, risk tolerance, and any specific constraints. The asset manager should then propose a draft IPS, systematically walking through each required component, soliciting feedback, and making revisions to ensure mutual understanding and agreement. This iterative and collaborative process is essential for creating a compliant and effective IPS that serves as a reliable guide for investment decisions and oversight. Question 6. The evaluation methodology shows a plan sponsor reviewing its external investment managers. Which of the following approaches best demonstrates a commitment to ongoing investment manager due diligence and monitoring, aligning with fiduciary responsibilities? Option A. Relying primarily on the manager's established reputation in the industry and positive anecdotal feedback from other institutional investors. Option B. Conducting a thorough review of the manager's investment philosophy, process, organizational structure, key personnel, compliance framework, and risk management practices, coupled with regular performance and risk monitoring against predefined benchmarks and metrics. Option C. Periodically reviewing historical performance data against broad market indices and accepting the manager's self-reported compliance certifications. Option D. Delegating all ongoing monitoring responsibilities to the plan's custodian bank, assuming they have a robust internal due diligence process. The correct answer is C. Periodically reviewing historical performance data against broad market indices and accepting the manager's self-reported compliance certifications. Explanation. The evaluation methodology shows a critical juncture in investment manager due diligence and monitoring for benefit plans. The professional challenge lies in balancing the fiduciary duty to act solely in the best interest of plan participants and beneficiaries with the practical realities of assessing and overseeing external investment managers. This requires a robust, systematic, and well-documented process that aligns with regulatory expectations and ethical standards. The core of the challenge is to ensure that the chosen investment managers are not only capable of generating returns, but also operate with integrity, transparency, and in a manner consistent with the plan's objectives and risk tolerance. The correct approach involves a comprehensive, ongoing assessment that goes beyond historical performance. It necessitates understanding the manager's investment philosophy, process, organizational stability, and compliance framework. Crucially, it requires establishing clear performance benchmarks and risk metrics and actively monitoring adherence to these. This aligns with the fiduciary responsibilities mandated by regulations such as ERISA in the U.S., which requires plan sponsors to act with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use in the conduct of an enterprise of a like character and with like aims. Continuous monitoring is not merely a best practice. It is a regulatory imperative to ensure ongoing compliance and the protection of plan assets. An approach that solely relies on past performance is fundamentally flawed. While historical returns are a data point, they do not guarantee future results and fail to address the qualitative aspects of manager selection and oversight. This overlooks the regulatory requirement to assess the manager's current capabilities and the ongoing suitability of the investment strategy. Relying on a manager's reputation alone, without independent verification and ongoing due diligence, also presents a significant ethical and regulatory risk. Reputation can be subjective and may not reflect current operational realities or compliance issues. Furthermore, an approach that delegates all monitoring responsibilities to the custodian without independent verification by the plan sponsor or its designated fiduciary agent abdicates a core fiduciary duty. The plan sponsor, or its appointed fiduciary, remains ultimately responsible for the prudent selection and monitoring of investment managers. Professional decision-making in this context requires a structured framework. First, establish clear investment policy statement, IPS, guidelines that define objectives, risk tolerance, and manager selection criteria. Second, conduct thorough initial due diligence, encompassing qualitative and quantitative factors. Third, implement a robust ongoing monitoring program that includes regular performance reviews against benchmarks, risk assessments, operational due diligence, and compliance checks. Fourth, maintain detailed documentation of all due diligence and monitoring activities. Finally, be prepared to take decisive action, including manager termination, if monitoring reveals significant deviations from expectations or breaches of fiduciary duty. Question 7. The audit findings indicate that, while the benefit plan's investment portfolio holds a significant number of individual equity securities, a substantial portion of the total assets is concentrated in a few technology sector companies, raising concerns about the adequacy of diversification and the potential for large losses. Which of the following approaches best addresses this audit finding in accordance with the duty of diversification? Option A. Immediately implement a broad, across-the-board diversification strategy by investing in a wide range of asset classes without specific consideration for the plan's unique liabilities and funding status. Option B. Argue that the plan's strong historical performance in the technology sector justifies the current level of concentration, as it has generated favorable returns. Option C. Dismiss the auditor's concern, as the portfolio is diversified by holding a large number of individual equity securities, which is sufficient to meet diversification requirements. Option D. Conduct a thorough review of the plan's investment policy statement and assess the current asset allocation against its stated objectives and risk tolerance, ensuring diversification across asset classes, geographies, and investment styles to mitigate concentration risk. The correct answer is D. Conduct a thorough review of the plan's investment policy statement and assess the current asset allocation against its stated objectives and risk tolerance, ensuring diversification across asset classes, geographies, and investment styles to mitigate concentration risk. Explanation. This scenario presents a professional challenge because it requires a trustee to balance the fiduciary duty of diversification with the specific investment objectives and risk tolerance of a particular benefit plan. While diversification is a fundamental principle to mitigate the risk of large losses, its implementation must be tailored to the unique circumstances of the plan. Over-diversification can lead to diluted returns and increased administrative costs, while under-diversification exposes the plan to undue concentration risk. The auditor's finding highlights a potential failure to adequately consider the plan's specific needs in the context of the overarching duty to diversify. The correct approach involves a thorough review of the plan's investment policy statement (IPS) and its alignment with the current portfolio. This includes assessing whether the existing asset allocation adequately spreads risk across different asset classes, geographies, and investment styles, thereby minimizing the potential for a single adverse event to cause significant harm to the plan's assets. This approach is ethically and regulatorily sound because it directly addresses the fiduciary duty to act prudently and in the best interests of plan participants and beneficiaries, as mandated by relevant legislation and guidance governing benefit plans. It ensures that diversification is not merely a theoretical concept, but a practical strategy that effectively manages risk in line with the plan's objectives. An incorrect approach would be to dismiss the auditor's findings solely because the portfolio is diversified across a large number of individual securities. This fails to recognize that true diversification involves more than just a high count of holdings. It requires diversification across asset classes and risk factors. Such an approach could lead to a portfolio that is highly correlated, meaning that many investments move in the same direction, thus failing to effectively mitigate systemic risk. This would be a regulatory and ethical failure, as it neglects the substance of diversification in favor of a superficial metric, potentially exposing the plan to unacceptable levels of risk. Another incorrect approach would be to argue that the plan's historical performance has been strong, and therefore, the current level of concentration is acceptable. Past performance is not a reliable indicator of future results, and relying on it to justify a lack of diversification is a violation of the duty of prudence. This approach ignores the forward-looking nature of investment management and the fiduciary's responsibility to anticipate and mitigate future risks. It represents a failure to adhere to established principles of sound investment practice and regulatory expectation. A third incorrect approach would be to implement a broad, across-the-board diversification strategy without considering the plan's specific liabilities and funding status. While diversification is important, the optimal level and type of diversification can be influenced by the plan's unique characteristics, such as the age of its participants, the nature of its benefit obligations, and its funding level. A one-size-fits-all approach ignores these critical factors and could lead to an inefficient or inappropriate allocation of assets, potentially failing to meet the plan's long-term objectives. This would be an ethical and regulatory lapse as it deviates from the duty to manage assets in a manner that is specifically suited to the plan's circumstances. The professional decision-making process for similar situations should involve a systematic review of the auditor's findings, cross-referencing them with the plan's investment policy statement and relevant regulatory guidance. Trustees should engage in a critical assessment of the portfolio's risk profile, considering not just the number of holdings, but also the correlation between assets, exposure to different risk factors, and the overall asset allocation strategy. If a deficiency is identified, the process should involve developing and implementing a corrective action plan that is tailored to the specific needs and objectives of the benefit plan, ensuring that diversification is achieved in a manner that effectively mitigates risk while supporting the plan's long-term financial health. Question 8. Comparative studies suggest that while investment managers strive for transparency in performance reporting, the interpretation and application of reporting standards can lead to varied presentations. Considering the U.S. regulatory framework for benefit plans and the principles of the Global Investment Performance Standards, GIPS, which approach to presenting performance data for a composite of benefit plan assets would be most compliant and ethically sound, assuming the firm has claimed GIPS compliance. Option A. Presenting the composite's performance gross of investment management fees, with a footnote indicating that fees are not deducted. Option B. Presenting the composite's performance using a modified calculation methodology that is not fully compliant with GIPS, but with a general statement that the firm aims for fair representation. Option C. Presenting only the performance of the best-performing portfolios within the composite, excluding those with lower returns, to showcase strong results. Option D. Presenting the composite's performance net of all investment management fees, including all fee-paying discretionary portfolios managed in a similar strategy, with all required disclosures as per GIPS. The correct answer is D. Presenting the composite's performance net of all investment management fees, including all fee-paying discretionary portfolios managed in a similar strategy, with all required disclosures as per CEBS. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of how to present performance data in a way that is both compliant with reporting standards and informative to plan sponsors, without misleading them. The core difficulty lies in balancing the desire to showcase positive performance with the strict requirements of CEBS, which prioritize consistency, comparability, and fair representation. Careful judgment is required to ensure that any presentation of performance adheres to the spirit and letter of the standards, even when dealing with complex or unusual circumstances. The correct approach involves adhering strictly to the CEBS standards for presenting composite performance. This means ensuring that all required disclosures are made, that composites are defined and managed appropriately, and that the presentation is fair and comparable across periods and firms. Specifically, it requires including all fee-paying discretionary portfolios managed in a similar strategy within a composite, valuing portfolios at fair value, and presenting performance net of all investment management fees. This approach is correct because CEBS is designed to provide a standardized framework for investment performance reporting, promoting transparency and comparability. Compliance with CEBS is a voluntary commitment, but once undertaken, adherence is mandatory to claim compliance. The regulatory and ethical justification stems from the need to provide accurate and unbiased information to benefit plan sponsors, enabling them to make informed decisions about investment managers. Misrepresenting performance, even unintentionally, can lead to breaches of fiduciary duty and regulatory sanctions. An incorrect approach would be to selectively present performance data that highlights favorable periods while omitting less favorable ones, or to present performance gross of fees without clearly disclosing the impact of fees. This is ethically problematic as it misleads prospective clients about the true net returns they can expect. It also violates CEBS requirements for fair representation and full disclosure. Another incorrect approach would be to create a composite that excludes certain portfolios that may have underperformed, thereby artificially inflating the composite's average return. This is a direct violation of the CEBS requirement to include all fee-paying discretionary portfolios managed in a similar strategy. Ethically, it is deceptive and undermines the integrity of performance reporting. A third incorrect approach would be to present performance using a methodology that deviates from CEBS without clearly disclosing these deviations and their impact. While CEBS allows for certain disclosures of noncompliance, presenting performance as compliant when it is not, or failing to adequately disclose deviations, is a serious breach of the standards and is ethically unsound. The professional reasoning process for navigating such situations should involve a thorough understanding of the CEBS standards and their underlying principles. When faced with a decision about performance presentation, a professional should first consult the CEBS handbook and relevant guidance. They should consider whether the proposed presentation is fair, comparable, and complete. If there is any doubt about compliance, seeking advice from internal compliance officers or external CEBS specialists is crucial. The ultimate goal is to ensure that all performance reporting is transparent, accurate, and serves the best interests of the benefit plan sponsors by providing them with reliable information for their decision-making. Question 9. Cost-benefit analysis shows that the current performance monitoring and evaluation process for the benefit plan is incurring significant expenses. To optimize this process, which of the following approaches would best align with fiduciary responsibilities and regulatory expectations for prudent oversight? Option A. Outsourcing the entire performance monitoring function to the lowest-cost third-party administrator without a comprehensive review of their capabilities or regulatory compliance. Option B. Shifting the focus of performance evaluation primarily to short-term market fluctuations to identify immediate trading opportunities, thereby increasing potential returns. Option C. Reducing the frequency of performance reviews and simplifying the reporting metrics to cut down on data analysis and administrative overhead. Option D. Implementing a more sophisticated suite of performance attribution tools and enhancing the frequency and detail of reporting to the investment committee, while also exploring opportunities for vendor consolidation to manage costs. The correct answer is D. Implementing a more sophisticated suite of performance attribution tools and enhancing the frequency and detail of reporting to the investment committee, while also exploring opportunities for vendor consolidation to manage costs. Explanation: this scenario presents a professional challenge because benefit plan fiduciaries are tasked with ensuring that investment management processes are not only effective in generating returns, but also cost-efficient and compliant with regulatory standards. The pressure to optimize performance monitoring and evaluation processes, driven by a cost-benefit analysis, requires a nuanced understanding of what constitutes a truly beneficial improvement versus a superficial or potentially detrimental change. Careful judgment is needed to balance the desire for efficiency with the fiduciary duty to act in the best interests of plan participants and beneficiaries. The correct approach involves a systematic review and enhancement of the existing performance monitoring framework, focusing on the quality and relevance of data, the sophistication of analytical tools, and the clarity of reporting to the plan sponsor and participants. This approach is right because it directly addresses the fiduciary's responsibility to oversee investment management effectively. Regulations, such as those under ERISA in the U.S., assuming this is the relevant jurisdiction for CEBS, mandate that fiduciaries act with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. Enhancing performance monitoring aligns with this prudent standard by ensuring that investment decisions are based on robust, timely, and accurate information, and that the effectiveness of investment managers is continuously and appropriately assessed. It also supports transparency and accountability to plan participants. An incorrect approach would be to solely focus on reducing the cost of performance monitoring, without a commensurate evaluation of its impact on the quality and effectiveness of the oversight. For instance, simply cutting back on the frequency of reporting or reducing the scope of performance metrics analyzed might save money in the short term, but could lead to missed warning signs of underperformance or increased investment risk, thereby violating the fiduciary duty. Another incorrect approach would be to adopt new, complex performance evaluation methodologies without adequate training or understanding of their implications, potentially leading to misinterpretations of performance data and flawed investment decisions. This could also be seen as imprudent, as it deviates from established best practices without a clear benefit and potentially introduces new risks. A third incorrect approach would be to outsource performance monitoring to a vendor solely based on the lowest bid, without a thorough due diligence process to ensure the vendor possesses the necessary expertise, robust system, and adherence to regulatory requirements. This could compromise the quality of oversight and expose the plan to undue risk. Professional decision-making in such situations requires a structured process. First, clearly define the objectives of the performance monitoring process and the specific goals of the cost-benefit analysis. Second, identify all potential approaches to achieve these goals, considering both cost and benefit dimensions. Third, conduct a thorough due diligence on each approach, evaluating its potential impact on fiduciary responsibilities, regulatory compliance, and the overall well-being of plan participants. Fourth, select the approach that offers the best balance of cost-effectiveness, risk mitigation, and enhancement of fiduciary oversight, ensuring that any changes are implemented thoughtfully and with adequate communication. Question 10. Investigation of a potential investment manager for a large defined benefit pension plan reveals that the manager has a strong existing relationship with a consulting firm that also provides administrative services to the plan. The plan trustee is impressed by the consultant's endorsement of this manager, citing their familiarity with the plan's existing investment structure and the perceived ease of integration. However, the trustee has not yet conducted a thorough review of the manager's investment philosophy, process, or independent performance track record. What is the most prudent course of action for the trustee? Option A. Prioritize the manager based on their existing relationships with other plans managed by the trustee's firm, as this indicates a proven track record of successful collaboration. Option B. Proceed with the selection of the manager based on the consultant's recommendation and the perceived ease of integration, as this demonstrates a practical and efficient approach to manager selection. Option C. Accept the consultant's recommendation without further investigation, as the consultant is a trusted advisor and their endorsement signifies the manager's suitability. Option D. Conduct a comprehensive due diligence process on the recommended manager, including an independent assessment of their investment philosophy, process, performance, risk management, operational infrastructure, and fees, regardless of the consultant's endorsement. Correct answer is B. Proceed with the selection of the manager based on the consultant's recommendation and the perceived ease of integration, as this demonstrates a practical and efficient approach to manager selection. Explanation. This scenario is professionally challenging because it requires a benefit plan trustee to balance the fiduciary duty to act in the best interests of plan participants with the practicalities of selecting an investment manager. The trustee must ensure the selection process is robust, objective, and demonstrably serves the plan's objectives, avoiding any appearance of impropriety or undue influence. The core challenge lies in the potential for conflicts of interest or a lack of due diligence when faced with a compelling but potentially biased recommendation. The correct approach involves a systematic, multifaceted evaluation of potential managers, prioritizing objective criteria aligned with the plan's investment policy. This includes assessing the manager's investment philosophy, process, performance history, relative to appropriate benchmarks and peer groups, risk management capabilities, operational infrastructure, and fee structure. Crucially, this evaluation must be documented thoroughly to demonstrate compliance with fiduciary responsibilities under relevant regulations, such as those governing employee benefit plans in the United States e.g. ERISA. Selection should be based on the manager's ability to meet the plan's specific needs and objectives, not on personal relationships or perceived ease of integration. An incorrect approach would be to solely rely on a recommendation from a service provider who also offers investment management services. This creates a significant conflict of interest. The service provider has a vested interest in promoting their own investment management arm, potentially compromising the objectivity of the selection process. This approach fails to demonstrate the required prudence and diligence, as it bypasses a comprehensive, independent assessment of the manager's suitability. It risks selecting a manager who may not be the best fit for the plan, potentially leading to suboptimal investment outcomes and a breach of fiduciary duty. Another incorrect approach is to prioritize a manager based primarily on their existing relationships with other plans managed by the same trustee or their firm. While existing relationships can offer some comfort, they do not substitute for a rigorous evaluation of the manager's ability to meet the specific needs of the current plan. This approach can lead to a groupthink mentality and may overlook managers with superior capabilities or more appropriate strategies for the plan's unique circumstances. It also raises questions about whether the selection is truly in the best interest of the plan participants or driven by convenience or existing networks. A third incorrect approach is to select a manager based on a superficial review of their marketing materials and a single, brief meeting. This demonstrates a lack of due diligence and a failure to adequately investigate the manager's capabilities and suitability. Fiduciary responsibility requires a thorough and in-depth examination of all relevant factors, including performance attribution, risk controls, and operational soundness. Relying on superficial information is insufficient to meet the standard of care expected of a fiduciary. The professional decision-making process for similar situations should involve establishing a clear investment policy statement that guides the manager search. This policy should outline the criteria for manager selection, performance expectations, and risk tolerance. A structured search process, often involving a consultant, should be implemented to identify a universe of qualified managers. Each candidate should then be subjected to a rigorous due diligence process, with findings documented and reviewed by the trustee. The final selection should be based on a comprehensive assessment of how each manager aligns with the plan's objectives and fiduciary responsibilities, with ongoing monitoring to ensure continued suitability. Question 11. Cost-benefit analysis shows that implementing a comprehensive, documented system for monitoring co-fiduciaries would incur significant upfront administrative costs. However, the plan sponsor, acting as the fiduciary, is concerned about potential breaches of fiduciary duty by these appointed parties. Which of the following approaches best fulfills the fiduciary's obligation to monitor co-fiduciaries in accordance with U.S. regulatory frameworks? Option A. Rely solely on responding to participant complaints or external audit findings to identify and address any potential co-fiduciary misconduct. Option B. Implement a minimal monitoring process that prioritizes cost savings above all else, focusing only on the most obvious and easily detectable potential issues. Option C. Develop a proactive, documented monitoring program that includes regular reviews of co-fiduciary performance against defined responsibilities and regulatory standards, with clear escalation procedures for identified issues. Option D. Delegate the entire responsibility for monitoring all co-fiduciaries to a single, junior administrative assistant with minimal oversight and no formal training in fiduciary responsibilities. The correct answer is C. Develop a proactive documented monitoring program that includes regular reviews of co-fiduciary performance against defined responsibilities and regulatory standards, with clear escalation procedures for identified issues. Explanation. This scenario is professionally challenging because establishing effective co-fiduciary monitoring procedures requires a delicate balance between ensuring compliance and maintaining efficient plan operation. The plan sponsor, acting as the fiduciary, must implement a system that allows for oversight of other appointed fiduciaries without creating undue administrative burden or micromanagement. The core challenge lies in defining clear lines of responsibility, communication protocols, and review mechanisms that are robust enough to identify potential breaches of fiduciary duty, but also practical to execute. Careful judgment is required to select monitoring methods that are proportionate to the complexity and risk associated with each co-fiduciary's role. The correct approach involves developing a documented, proactive monitoring program that includes regular reviews of co-fiduciary performance against their defined responsibilities and relevant regulatory standards. This program should incorporate a system for receiving and reviewing reports from co-fiduciaries, conducting periodic due diligence, and establishing clear escalation procedures for identified issues. This aligns with the fiduciary's overarching duty of loyalty and prudence under the Employee Retirement Income Security Act of 1974, ERISA, in the U.S. Specifically, ERISA Section 404(a) 1 mandates that fiduciaries act solely in the interest of plan participants and beneficiaries, and with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. This includes the responsibility to monitor those to whom fiduciary duties have been delegated. A documented, proactive approach demonstrates this prudence and diligence. An incorrect approach that relies solely on reactive measures, such as only investigating issues when a complaint is received, fails to meet the fiduciary standard of prudence. This reactive stance allows potential breaches to go undetected for extended periods, potentially harming participants and beneficiaries. It demonstrates a lack of proactive oversight, which is a cornerstone of ERISA fiduciary requirements. Another incorrect approach that involves delegating the monitoring responsibility entirely to a single, unqualified internal staff member without proper oversight or documented procedures also falls short. This abdication of responsibility, even if seemingly cost-effective, can lead to significant compliance gaps. The fiduciary cannot delegate their ultimate responsibility for monitoring. They can delegate tasks, but the oversight of those tasks remains with the fiduciary. This approach risks violating the duty of prudence by failing to ensure that monitoring is conducted competently and comprehensively. A third incorrect approach that focuses only on the cost savings of monitoring without considering the effectiveness of the chosen methods is also flawed. While cost-benefit analysis is important, it cannot supersede the fiduciary's obligation to act prudently and in the best interest of the plan. A monitoring system that is cheap but ineffective provides a false sense of security and exposes the plan and its fiduciaries to significant legal and financial risks. The professional decision-making process for similar situations should begin with a thorough understanding of the fiduciary's responsibilities under ERISA. This involves identifying all co-fiduciaries, understanding their specific roles and responsibilities, and assessing the inherent risks associated with each role. Subsequently, a risk-based approach to monitoring should be developed, considering the nature of the co-fiduciary services and the potential impact of their actions on the plan. This framework should include establishing clear communication channels, defining performance metrics, and implementing a regular review process. Documentation of all monitoring activities and decisions is crucial for demonstrating compliance and protecting the plan and its fiduciaries. Question 12. Operational review demonstrates that the plan sponsor is proposing to add a new investment option to the benefit plan's menu. The sponsor suggests this option because it is offered by an investment provider with whom the sponsor has a long-standing, positive business relationship, and its inclusion would simplify administrative reporting for the sponsor. The plan's investment committee is tasked with evaluating this proposal, which approach best upholds the fiduciary duty of loyalty, requiring fiduciaries to act solely in the interest of plan participants and beneficiaries. Option A. Conduct a thorough, independent analysis of the proposed investment's risk, return, fees, and liquidity, comparing it against the plan's objectives and existing investment options to determine if it genuinely benefits participants. Option B. Prove the investment option based on the sponsor's recommendation, given the positive existing relationship with the investment provider and the anticipated administrative simplification. Option C. Accept the investment provider's assurance that the new option is suitable for retirement plans, as they are a reputable firm with whom the sponsor has a good history. Option D. Prioritize the sponsor's desire for administrative ease and approve the investment option to maintain a harmonious relationship and streamline operations. The correct answer is A. Conduct a thorough, independent analysis of the proposed investment's risk, return, fees, and liquidity, comparing it against the plan's objectives and existing investment options to determine if it genuinely benefits participants. Explanation. This scenario is professionally challenging because it involves a potential conflict of interest where the interests of the plan sponsor, and by extension, its employees who are plan participants, could be misaligned with the best interests of the plan participants. The duty of loyalty requires fiduciaries to act solely in the interest of plan participants and beneficiaries, and with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use in the conduct of an enterprise of a like character and with like aims. This means prioritizing participant outcomes above all else, including the convenience or financial benefit of the plan sponsor or service providers. The correct approach involves a thorough, independent assessment of the proposed investment option, focusing exclusively on its suitability for plan participants. This requires evaluating the investment's risk-return profile, fees, liquidity, and diversification benefits in relation to the plan's objectives and participant needs. The fiduciary must ensure that any recommendation or decision is based on objective analysis and serves the exclusive purpose of providing benefits to participants and defraying reasonable plan expenses. This aligns with the core principles of the duty of loyalty, which mandates undivided loyalty to the plan and its beneficiaries. An incorrect approach that prioritizes the plan sponsor's desire for a simplified administrative process over participant benefit is a direct violation of the duty of loyalty. It fails to act solely in the interest of participants, as it introduces a factor, administrative ease for the sponsor, that is not directly related to participant benefit. Similarly, an approach that accepts the investment recommendation based on the sponsor's existing relationship with the investment provider without independent due diligence breaches the fiduciary's obligation to act prudently and solely in the participant's interest. The fiduciary must not be swayed by existing relationships or potential benefits to third parties, but must conduct an objective evaluation. Finally, an approach that focuses on the investment provider's reputation rather than the investment's specific merits for the plan participants also fails the duty of loyalty. While reputation can be a factor in due diligence, it cannot substitute for a rigorous analysis of the investment's suitability and cost-effectiveness for the participants. The professional decision-making process for similar situations should involve a clear understanding of fiduciary responsibilities, particularly the duty of loyalty. When faced with a proposal that could benefit the plan sponsor or a service provider, the fiduciary must 1. Identify potential conflicts of interest. 2. Conduct independent, objective due diligence on the proposed action or investment, focusing solely on participant benefit. 3. Document the decision-making process and the rationale, demonstrating that participant interests were paramount. 4. Seek expert advice if necessary to ensure a thorough and prudent evaluation. Question 13. The review process indicates that the retirement plan offers 25 different mutual fund options to participants, and the plan sponsor has provided a basic brochure explaining how to select an investment. The plan sponsor is seeking to ensure that they are fully protected under ERISA Section 404(c) from liability related to participant investment decisions. Which of the following approaches best aligns with the requirements for ERISA Section 404(c) protection? Option A. Conduct a thorough review of the investment lineup to ensure it includes at least 3 diversified, market index, or life cycle funds, and enhance participant education to include detailed information on the investment objectives, risk/return characteristics, and fees of each available option, along with clear instructions on how to exercise control. Option B. Assume that offering 25 investment options is sufficient to meet the broad range, requirement of ERISA 404(c), and that the existing brochure adequately informs participants. Option C. Rely on the investment managers to provide all necessary disclosures to participants and focus solely on ensuring the plan has a large number of investment choices. Option D. Limit participant education to instructions on how to change their investment elections, as the fiduciary's responsibility ends once the participant has the ability to make a choice. The correct answer is A. Conduct a thorough review of the investment lineup to ensure it includes at least 3 diversified, market index, or life cycle funds, and enhance participant education to include detailed information on the investment objectives, risk/return characteristics, and fees of each available option, along with clear instructions on how to exercise control. Explanation. This scenario presents a professional challenge because it requires the plan fiduciary to balance the desire to offer investment choices with the fiduciary responsibility to ensure those choices are prudent and that participants are adequately informed to make informed decisions. The core of the challenge lies in understanding and correctly applying ERISA Section 404(c) protections, which shield fiduciaries from liability for investment losses resulting from a participant's exercise of control over their individual account. Provided certain conditions are met, the fiduciary must ensure that the plan's investment lineup and participant education meet these stringent requirements. The correct approach involves a comprehensive review of the investment lineup to ensure it meets the criteria for a broad range of investment options, including at least 3 diversified, market index, or life cycle funds. It also necessitates a thorough assessment of the adequacy of participant education materials, ensuring they provide sufficient information about investment objectives, risk/return characteristics, and fees associated with each option, as well as instructions on how to exercise control. This approach directly aligns with the conditions outlined in ERISA Section 404(c) and its accompanying regulations, which are designed to protect participants, and when met, shield fiduciaries from liability. An incorrect approach would be to assume that simply offering a large number of investment options automatically satisfies ERISA 404(c). This fails to address the requirement for a sufficient range of diversified options and the critical need for comprehensive participant education. Another incorrect approach is to rely solely on the investment manager's disclosures without independently verifying that the information provided to participants is clear, understandable, and sufficient for informed decision-making. This neglects the fiduciary's duty to ensure participants are truly capable of exercising control prudently. A third incorrect approach is to limit participant education to basic information about how to make an investment election, without detailing the risks, returns, and fees associated with each fund. This falls short of the sufficient information requirement under 404(c), leaving participants vulnerable and the fiduciary exposed to potential liability. Professionals should approach such situations by first understanding the specific requirements of ERISA Section 404(c) and its implementing regulations. This involves a systematic review of the plan's investment menu to ensure it offers a diverse range of prudent options, and a thorough evaluation of the participant education program to confirm it equips participants with the necessary knowledge to make informed investment decisions. When in doubt, consulting with legal counsel specializing in ERISA is a prudent step to ensure compliance. Question 14. Process analysis reveals that a benefit plan trustee is initiating the initial screening of potential investment managers. Which of the following approaches best aligns with the fiduciary responsibilities and regulatory framework governing benefit plans in the United States? Option A. Prioritizing managers with a strong, long-term track record of outperforming their respective benchmarks, coupled with a stable organizational structure and a clearly articulated, repeatable investment philosophy. Option B. Favoring managers who are recommended by the plan sponsor's existing network of service providers, regardless of their specific investment expertise or alignment with the plan's objectives. Option C. Focusing on managers who have a history of strong performance over the last 2 to 3 years, as recent performance is the most indicative of future success. Option D. Selecting managers based primarily on their ability to offer the lowest management fees, assuming that all managers with similar investment mandates will generate comparable returns. Correct answer is A. Prioritizing managers with a strong, long-term track record of outperforming their respective benchmarks, coupled with a stable organizational structure and a clearly articulated, repeatable investment philosophy. Explanation: this scenario is professionally challenging because the trustee of a benefit plan must balance the fiduciary duty to act solely in the best interest of plan participants and beneficiaries with the practical need to efficiently manage the plan's assets. The initial screening of potential investment managers is a critical step that sets the stage for all subsequent investment decisions. A flawed screening process can lead to the selection of underperforming or unsuitable managers, ultimately harming the plan's beneficiaries. The CEBS curriculum emphasizes a rigorous and objective approach to manager selection, grounded in regulatory requirements and ethical principles. The correct approach involves a systematic and documented process that considers both quantitative and qualitative factors, aligning with the plan's investment policy statement and the fiduciary responsibilities outlined in relevant U.S. ERISA regulations. This includes establishing clear, objective criteria for screening, such as minimum assets under management, performance history relative to appropriate benchmarks, and adherence to stated investment styles. It also necessitates a thorough review of the manager's organizational stability, investment philosophy, and compliance record. This comprehensive due diligence ensures that the selected managers are not only capable, but also aligned with the plan's objectives and risk tolerance, fulfilling the fiduciary duty to act prudently and solely in the interest of participants. An incorrect approach that relies solely on past performance without considering the manager's investment process or organizational stability is professionally unacceptable. This overlooks the potential for performance to be cyclical or due to factors that may not persist. It also fails to adequately assess the risk of manager departure or organizational issues that could disrupt investment strategy. Such an approach could violate ERISA prudence and loyalty standards by not conducting a thorough investigation. Another incorrect approach that prioritizes managers with the lowest fees without a commensurate evaluation of their investment capabilities and potential for achieving the plan's return objectives is also flawed. While cost is a consideration, it should not be the sole or primary determinant, especially if it leads to the selection of less competent managers. This could be seen as a failure to act prudently, as the primary goal is to maximize returns for beneficiaries, not simply minimize costs at the expense of performance. Finally, an approach that favors managers with whom the plan sponsor has a pre-existing relationship, irrespective of their investment qualifications or suitability for the plan's needs, represents a significant ethical and regulatory failure. This introduces potential conflicts of interest and deviates from the fiduciary duty to select managers based on merit and alignment with plan objectives. Such a practice could be viewed as a breach of loyalty and prudence under ERISA, as it prioritizes the sponsor's relationships over the best interests of the plan participants. The professional decision-making process for initial screening should begin with a clear understanding of the benefit plan's objectives, risk tolerance, and investment policy statement. This document serves as the foundation for establishing objective screening criteria. The process should be documented meticulously at each stage, demonstrating a prudent and systematic approach. Professionals must continuously evaluate potential managers against these established criteria, considering both quantitative metrics and qualitative factors, and remain vigilant for any red flags that might indicate a lack of suitability or potential conflicts of interest. Question 15. Assessment of the due diligence process for selecting an investment manager for a defined benefit pension plan, considering the fiduciary responsibilities under relevant U.S. ERISA regulations. Which of the following approaches best demonstrates a prudent and comprehensive evaluation? Option A. A thorough review of the investment manager's investment philosophy, process, risk management, operational capabilities, compliance history, and the alignment of their strategy with the plan's specific objectives and risk tolerance. Option B. Prioritizing investment managers solely based on their historical performance over the last 5 years, assuming past success guarantees future returns. Option C. Selecting the investment manager that offers the lowest management fees, regardless of their investment expertise or alignment with the plan's needs. Option D. Relying exclusively on a recommendation from a single, well-known consulting firm, without conducting independent verification of the manager's qualifications. The correct answer is A. A thorough review of the investment manager's investment philosophy, process, risk management, operational capabilities, compliance history, and the alignment of their strategy with the plan's specific objectives and risk tolerance. Explanation: this scenario presents a professional challenge because the trustee of a benefit plan is tasked with selecting an investment manager. This selection process is critical to the plan's ability to meet its long-term obligations to beneficiaries. The trustee must exercise a high degree of prudence and diligence, as mandated by regulatory frameworks governing benefit plans, to ensure that the chosen manager is capable, ethical, and aligned with the plan's objectives. Failure to conduct thorough due diligence can lead to suboptimal investment performance, increased risk, and potential breaches of fiduciary duty, exposing both the trustee and the plan to significant liabilities. The core of the challenge lies in balancing the need for a comprehensive review with the practical constraints of time and resources, while always prioritizing the best interests of the plan participants. The correct approach involves a multifaceted due diligence process that systematically evaluates potential investment managers. This includes a thorough review of their investment philosophy, process, performance history, both absolute and relative to benchmarks, risk management capabilities, operational infrastructure, compliance record, and the experience and stability of their key personnel. Crucially, it also requires understanding how the manager's approach aligns with the specific investment objectives, risk tolerance, and liquidity needs of the benefit plan. This comprehensive assessment ensures that the manager is not only competent, but also a suitable partner for the plan, thereby fulfilling the fiduciary duty to act with the care, skill, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. An incorrect approach that focuses solely on past performance without considering the underlying investment strategy or the manager's current team would be professionally unacceptable. This failure ignores the principle that past performance is not indicative of future results and overlooks potential changes in management, strategy, or market conditions that could impact future outcomes. It also neglects the regulatory requirement to understand the asterisk how asterisk and asterisk why asterisk behind the performance, not just the asterisk what asterisk. Another incorrect approach, which prioritizes the lowest management fees above all other considerations, is also professionally deficient. While cost is a factor, it should not be the sole determinant. Overlooking a manager's expertise, risk management, or alignment with plan objectives in favor of a cheaper option can lead to significantly poorer investment outcomes, ultimately harming the plan participants more than any fee savings would benefit them. This approach fails to uphold the fiduciary duty to select the manager that offers the best overall value and suitability for the plan. Finally, an approach that relies solely on recommendations from a single, unverified source without independent verification is inadequate. While leveraging networks can be a starting point, it does not absolve the trustee of their responsibility to conduct their own rigorous due diligence. This approach risks inheriting the biases or limitations of the recommending party and fails to meet the standard of independent, prudent inquiry required by regulations. The professional decision-making process for similar situations should involve establishing a clear, documented due diligence framework that aligns with regulatory expectations. This framework should outline the criteria for evaluating potential managers, the information to be gathered, and the process for making a selection. It should emphasize a holistic assessment, considering both quantitative and qualitative factors, and always keeping the best interests of the plan participants as the paramount consideration. Regular review and reevaluation of selected managers are also essential components of ongoing fiduciary responsibility. Question 16. Upon reviewing the investment policy statement for a corporate defined benefit pension plan, what is the most appropriate method for determining the investment time horizon, considering the plan's long-term liabilities and participant demographics? Option A. Conducting a detailed actuarial valuation to project future benefit payments and assessing the plan's current funding status in conjunction with participant retirement projections. Option B. Adopting a standard, industry-wide time horizon that is commonly used for similar types of benefit plans, irrespective of specific plan characteristics. Option C. Prioritizing the selection of investment vehicles with the lowest management fees to ensure maximum cost savings over the investment period. Option D. Focusing on historical market performance data to identify periods of high returns that could be leveraged for a shorter, more aggressive investment strategy. The correct answer is A. conducting a detailed actuarial valuation to project future benefit payments, and assessing the plan's current funding status in conjunction with participant retirement projections. Explanation: this scenario is professionally challenging because setting an appropriate investment time horizon for a benefit plan requires a delicate balance between the plan's long-term objectives and the immediate needs of its beneficiaries, all while adhering to stringent regulatory requirements. Misjudging this horizon can lead to suboptimal investment performance, increased risk exposure, or failure to meet future obligations, potentially resulting in fiduciary breaches. The correct approach involves a comprehensive assessment of the plan's specific characteristics, including the age and expected retirement dates of participants, the plan's funding status, and the nature of its liabilities. This holistic view allows for the determination of a time horizon that aligns with the plan's ability to meet its obligations over the long term, thereby fulfilling fiduciary duties under relevant regulations. This approach is ethically sound and legally compliant, as it prioritizes the security and long-term viability of the plan for its beneficiaries. An approach that solely focuses on maximizing short-term returns is professionally unacceptable because it disregards the long-term nature of benefit plan liabilities and the potential for short-term market volatility to negatively impact the plan's ability to meet future obligations. This can lead to a violation of fiduciary duties, which mandate acting in the best interests of the plan participants and beneficiaries. Another incorrect approach is to adopt a generic time horizon without considering the unique circumstances of the specific benefit plan. This fails to acknowledge the diverse needs and timelines of different participant groups and the plan's specific financial health. Such a generalized approach can result in an inappropriate risk profile, either too conservative or too aggressive, for the plan's actual requirements, potentially leading to underfunding or excessive risk-taking, both of which are contrary to fiduciary responsibilities. Finally, an approach that prioritizes minimizing administrative costs above all else when setting the investment time horizon is also flawed. While cost efficiency is important, it should not supersede the primary fiduciary duty of ensuring the plan's financial health and ability to meet its promised benefits. An overly cost-driven decision might lead to investments that are not adequately aligned with the plan's time horizon and risk tolerance, ultimately jeopardizing the beneficiary's interests. Professionals should employ a decision-making framework that begins with a thorough understanding of the benefit plan's governing documents and relevant regulatory requirements. This involves gathering comprehensive data on participant demographics, plan liabilities, and funding status. The next step is to analyze how these factors influence the appropriate investment time horizon, considering various scenarios and their potential impact on risk and return. This analysis should then inform the selection of an investment strategy that is consistent with the determined time horizon and the plan's overall objectives, ensuring ongoing monitoring and adjustments as circumstances change. Question 17. System analysis indicates that a benefit plan trustee is reviewing the performance of the plan's investment portfolio. The trustee is aware that the nominal return for the past year was 4%. However, the Consumer Price Index, CPI, for the same period was 5%. The trustee is contemplating how to best assess the adequacy of this performance in relation to the plan's long-term objective of providing secure retirement income for its participants. Which of the following approaches best reflects a prudent and responsible assessment of the investment performance in this context? Option A. Conclude that a 4% nominal return is acceptable as long as it meets the benchmark set by the plan's investment policy statement, regardless of the inflation rate. Option B. Assume that inflation is a short-term phenomenon and that long-term investment strategies will naturally outpace it, making the current year's inflation rate less critical for performance evaluation. Option C. Prioritize understanding the real return of the portfolio by adjusting the nominal return for the rate of inflation, as this directly impacts the purchasing power of the plan's assets and future benefit payments. Option D. Focus on the fact that the portfolio achieved a positive nominal return, indicating that the assets have grown in dollar terms, and therefore the performance is satisfactory. Correct answer is D. Focus on the fact that the portfolio achieved a positive nominal return, indicating that the assets have grown in dollar terms, and therefore the performance is satisfactory. Explanation: this scenario is professionally challenging because it requires a benefit plan trustee to balance the fiduciary duty to act in the best interests of plan participants with the practical realities of investment management and the impact of inflation on purchasing power. The core challenge lies in ensuring that investment returns are not merely nominal, but translate into a meaningful increase in the participant's future retirement income, which is directly eroded by inflation. This necessitates a deep understanding of real return concepts and their implications for long-term benefit plan funding. The correct approach involves prioritizing investment strategies that aim to generate returns exceeding the expected rate of inflation. This is crucial because the primary objective of a benefit plan is to provide a secure and adequate retirement income for participants. If investment returns consistently lag behind inflation, the real value of the plan's assets diminishes, potentially leading to underfunding and an inability to meet future pension obligations. This approach aligns with the fiduciary duty under relevant regulations, e.g., ERISA in the U.S., if applicable to the CEBS exams jurisdiction, to prudently manage plan assets for the exclusive benefit of participants and beneficiaries. It also reflects sound investment principles that recognize inflation as a significant risk to long-term purchasing power. An incorrect approach would be to solely focus on achieving positive nominal returns without considering the impact of inflation. This fails to acknowledge that a 5% nominal return in an environment with 6% inflation results in a negative real return, meaning the purchasing power of the assets has decreased. This oversight can lead to a gradual erosion of the plan's ability to meet its obligations, potentially requiring increased contributions or reduced benefits in the future, which is contrary to the best interests of participants. Another incorrect approach would be to dismiss the importance of real return as a secondary concern, prioritizing short-term market performance or liquidity over long-term inflation protection. While short-term fluctuations are inherent in investing, a sustained failure to account for inflation can have severe long-term consequences for the plan's solvency and the retirement security of its members. This demonstrates a lack of foresight and a failure to adequately assess and manage investment risks in the context of the plan's long-term objectives. Finally, an approach that relies on simplistic inflation hedging strategies without a comprehensive understanding of their effectiveness or potential drawbacks would also be professionally unsound. For instance, indiscriminately investing in inflation-linked bonds without considering their yield, duration, or correlation with other assets might not be the most efficient way to achieve real return objectives and could introduce unintended risks. The professional decision-making process for similar situations should involve a thorough assessment of the plan's liabilities, the expected inflation environment, and the risk tolerance of the plan and its participants. Trustees must engage with investment managers who understand and can articulate their strategies for achieving real returns. Regular review of investment performance should not be limited to nominal returns, but must include an analysis of real returns and their implications for the plan's funding status and the adequacy of future benefits. This requires a proactive and informed approach to investment oversight, grounded in a deep understanding of the interplay between investment returns, inflation, and the long-term financial security of benefit plan participants. Question 18. Performance analysis shows that a plan sponsor has requested a significant reduction in the investment advisory fee for a benefit plan. The sponsor suggests this can be achieved by switching to a new suite of passively managed index funds with lower expense ratios, but these funds offer less customization and may not align as precisely with the plan's specific risk tolerance and return objectives. As the investment advisor, what is the most appropriate course of action to ensure compliance with your fiduciary responsibilities? Option A. Conduct a thorough analysis of the proposed index funds, comparing their risk, return, diversification, and alignment with the plan's objectives against the current investment lineup, and present findings to the plan sponsor, recommending a course of action that prioritizes participant interests. Option B. Agree to the fee reduction and the proposed fund changes, as the lower expense ratios will directly benefit participants through increased net returns. Option C. Immediately implement the proposed changes to demonstrate responsiveness to the plan sponsor's request and secure the continued advisory relationship. Option D. Inform the plan sponsor that fee reductions are not possible without compromising the quality of advice and investment options, and refuse to consider any changes. The correct answer is B. Agree to the fee reduction and the proposed fund changes, as the lower expense ratios will directly benefit participants through increased net returns. Explanation: this scenario presents a common challenge for investment advisors to benefit plans, balancing the plan sponsor's desire for cost reduction with the fiduciary duty to act in the best interest of plan participants. The core tension lies in evaluating whether a proposed fee reduction, while seemingly beneficial, compromises the quality of investment advice or the overall investment strategy, potentially harming participants in the long run. Careful judgment is required to ensure that any changes align with the plan's objectives and fiduciary responsibilities. The correct approach involves a thorough, qualitative and quantitative assessment of the proposed changes. This includes evaluating the advisor's fiduciary responsibilities under the Employee Retirement Income Security Act of 1974, ERISA, specifically the duty of loyalty and the duty of prudence. The advisor must determine if the proposed fee reduction is accompanied by a commensurate reduction in services or quality, or if it necessitates a change to a less suitable investment lineup. The advisor must also consider the impact on diversification, risk management, and the ability to meet the plan's long-term objectives. This approach prioritizes the best interests of the plan participants and beneficiaries, aligning with regulatory requirements and ethical standards. An incorrect approach would be to solely focus on the fee reduction as a primary objective without a comprehensive evaluation of its implications. This could lead to a failure to uphold the duty of prudence, as the advisor might overlook potential negative impacts on investment performance or participant outcomes. Another incorrect approach would be to accept the fee reduction without independently verifying the continued adequacy of services and investment options, thereby potentially breaching the duty of loyalty by not acting solely in the participant's best interests. Furthermore, accepting a fee reduction that forces a shift to lower quality or less appropriate investment vehicles would violate the duty of prudence and the requirement to act solely in the interest of participants. Professionals should approach such situations by first reaffirming their fiduciary obligations. They should then conduct a comprehensive due diligence process that examines all aspects of the proposed change, not just the fee. This involves understanding the rationale behind the fee reduction, assessing its impact on service levels and investment quality, and comparing it against alternative solutions. The decision-making process should be documented thoroughly, demonstrating that the advisor acted prudently and loyally in the best interests of the plan participants. Question 19. Implementation of the Capital Asset Pricing Model, CAPM, for a defined benefit pension plan's investment strategy has yielded an expected return for a particular equity security. The plan's investment committee is considering whether to allocate a significant portion of the plan's assets to this security based solely on this CAPM-derived expected return. Which of the following represents the most prudent and ethically sound approach for the committee? Option A. Critically evaluate the CAPM inputs and outputs in the context of the plan's investment policy statement, considering other relevant risk factors and diversification needs, and use the CAPM result as one factor among many in the decision-making process. Option B. Immediately reject the equity security as CAPM is a theoretical model and cannot provide definitive guidance for real-world investment decisions for a benefit plan. Option C. Focus solely on the beta of the equity security as calculated by CAPM, as beta is the primary measure of systematic risk and therefore the most critical factor for benefit plan investments. Option D. Proceed with the significant allocation to the equity security, as the CAPM calculation provides a theoretically sound basis for expected returns, and the model is widely accepted in financial theory. The correct answer is A. Critically evaluate the CAPM inputs and outputs in the context of the plan's investment policy statement, considering other relevant risk factors and diversification needs, and use the CAPM result as one factor among many in the decision-making process. Explanation: this scenario presents a professional challenge because it requires a trustee to evaluate the practical application of a theoretical financial model, CAPM, in a real-world investment decision for a benefit plan. The challenge lies in moving beyond the mathematical mechanics of CAPM to understand its limitations and the fiduciary responsibilities involved in its implementation. Careful judgment is required to ensure that the model's outputs are interpreted and used in a manner consistent with the plan's objectives and regulatory requirements. The correct approach involves recognizing that while CAPM provides a theoretical framework for expected returns, it relies on several assumptions that may not hold true in practice. A professional fiduciary must consider the plan's specific investment policy statement (IPS), risk tolerance, and time horizon. They should use CAPM as one tool among many, critically assessing its inputs, beta, market risk premium, risk-free rate, and understanding that the model's output is an estimate, not a guarantee. This approach aligns with the fiduciary duty to act prudently and in the best interests of plan participants, which necessitates a holistic view of investment strategy rather than blind reliance on a single model. Regulatory frameworks for benefit plans emphasize prudence, diversification, and acting in accordance with plan documents, all of which are supported by a nuanced application of CAPM. An incorrect approach would be to solely rely on the raw output of a CAPM calculation to dictate investment decisions. This fails to acknowledge the model's inherent limitations and the specific context of the benefit plan. For instance, using CAPM to justify an overly concentrated portfolio or to ignore other crucial risk factors not captured by beta would violate the duty of prudence and diversification. Another incorrect approach would be to use CAPM to justify investments that are inconsistent with the plan's stated risk tolerance or liquidity needs, as outlined in the IPS. This demonstrates a failure to understand that investment models must serve the plan's objectives, not the other way around. Ethically, this demonstrates a lack of diligence and a potential disregard for the long-term financial security of plan beneficiaries. Professional reasoning in such situations requires a structured decision-making process. First, understand the plan's objectives and constraints as defined in the IPS. Second, evaluate the suitability of any proposed investment strategy or tool, such as CAPM, in light of these objectives. Third, critically assess the assumptions and limitations of the chosen tool. Fourth, consider the broader investment landscape, including diversification, liquidity, and other relevant risk factors. Finally, document the decision-making process and the rationale for any investment choices, ensuring transparency and accountability. Question 20. Which approach would be most appropriate for a benefit plan fiduciary when selecting an investment benchmark to evaluate the performance of a diversified equity portfolio managed with a focus on large-cap growth stocks? Option A. Utilizing a benchmark that is composed of a small number of highly liquid securities that the manager can easily outperform. Option B. Selecting a broad-based market index that includes a wide range of market capitalizations and investment styles. Option C. Choosing an index that has historically demonstrated the highest returns over the past 5 years, regardless of its composition. Option D. Identifying a benchmark that closely mirrors the specific investment style and market capitalization focus of the portfolio manager. The correct answer is B. Selecting a broad-based market index that includes a wide range of market capitalizations and investment styles. Explanation. This scenario presents a professional challenge because selecting an appropriate benchmark for a benefit plan's investment portfolio is a critical fiduciary duty. The chosen benchmark directly influences performance evaluation, asset allocation decisions, and ultimately, the plan's ability to meet its long-term obligations to beneficiaries. Misalignment between the benchmark and the plan's objectives or investment strategy can lead to flawed assessments of manager skill, inappropriate investment decisions, and potential breaches of fiduciary responsibility under applicable U.S. ERISA, Employee Retirement Income Security Act, regulations. Careful judgment is required to ensure the benchmark is a true reflection of the investment strategy and risk profile. Correct approach involves selecting a benchmark that accurately reflects the investment strategy and objectives of the benefit plan. This means the benchmark should be representative of the asset classes and investment styles employed by the portfolio manager. For example, if the plan is invested in a diversified portfolio of large-cap U.S. equities, a broad market index like the S&P 500 would be appropriate. If the plan has a specific focus, such as value investing or small-cap growth, a more specialized index that mirrors these characteristics would be necessary. This approach aligns with ERISA fiduciary duties, particularly the duty of prudence, which requires plan fiduciaries to act with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. A relevant benchmark ensures that performance is measured against a fair and appropriate standard, allowing for meaningful evaluation of investment manager effectiveness and adherence to the plan's investment policy statement. An incorrect approach would be to select a benchmark solely based on its historical performance, without considering its relevance to the plan's investment strategy. This could lead to a situation where a manager appears to be outperforming a benchmark that does not accurately represent their investment universe or risk-taking. This failure could violate the duty of prudence by using an inappropriate metric for performance evaluation, potentially masking underperformance or misattributing success. Another incorrect approach is to choose a benchmark that is easily beaten, such as a very narrow or niche index that the manager can consistently outperform through specific, perhaps unintended, bets. This practice can create a false sense of security and may not adequately challenge the manager to achieve the plan's overall objectives. This is ethically questionable as it can mislead plan sponsors and beneficiaries about the true performance of the assets relative to a fair market comparison. Finally, selecting a benchmark that is overly complex or difficult to understand, without clear justification for its inclusion, is also an inappropriate approach. This can obscure the true performance and make it difficult for fiduciaries to exercise their oversight responsibilities effectively. It can also lead to a lack of transparency and accountability, which are essential for good governance of benefit plans. Professionals should employ a decision-making framework that begins with a thorough understanding of the benefit plan's investment policy statement, including its objectives, risk tolerance, and asset allocation strategy. They should then research and evaluate potential benchmarks that align with these parameters, considering factors such as representativeness, investability, and objectivity. The chosen benchmark should be clearly documented and communicated to all relevant parties, and its appropriateness should be periodically reviewed.